Right. That is a really, really good point. All right. I think we're starting. Make sure this is working. Got my camera on. Okay. We are live on Facebook. We are recording on Zoom. Everyone, welcome to the Multifamily Investment Club weekly update. We've got some interesting things to talk about today. Michael, you and I were just talking about it's really hard to go broke when you own thousands of doors in multifamily if you've bought well. We're extremely conservative, so that's what we plan on is weathering any type of financial storm. And on the other hand, I'm gonna share my screen here. There's an article about someone, and I'm gonna let you explain what happened. Can you see my screen okay right there?
Yes.
So I haven't logged into my Bloomberg account yet, but someone's in a death spiral right now. Let's why don't you take it away, Michael?
Young kid, his name was not that young, but he's young enough, 30 years old. The wunderkind of crypto, Sam Bankman-Fried, very, very, very smart guy. But unfortunately, he had a hedge fund of sorts called FTX, or actually Alameda Research and FTX. And unfortunately, his net worth was, I don't know, $20–30 billion about 6 months ago. And now, unless somebody bails him out, which could happen, FTX is going to be bankrupt within the next few days. And it's really unfortunate because he's a very, very talented guy. A lot of people believed in him. And there's nothing wrong with crypto or bonds or stocks or jewelry, gold, any of the things. The problem is that, again, they don't offer the same things that conservative multifamily real estate offers. It doesn't offer cash flow. It doesn't offer depreciation. It doesn't offer scale. It doesn't offer control. It doesn't offer leverage. So if you want to gamble, which basically that's what crypto is, there's nothing wrong with that. No one's going to judge you. You can do that, but let's get crystal clear about the differences. Period. Now, if you've made money in crypto, God bless you. I hope you made $1 billion. But this guy was hanging out with Bill Clinton and Tony Blair and the most beautiful people in the world.
And you just call Bill Clinton beautiful?
I'm sorry, I meant Hillary.
They hang out with the most beautiful people in the world.
That's right. So I'll tell you who the most beautiful person is that I know is my banker, because and our lenders and my partners. Those are beautiful people because with them I can buy multifamily till I'm blue in the face and keep having more cash flow, more depreciation, more leverage, more scale, and more control. Those are the beautiful people in my life. So look, this is not to rub it in anybody's face. You never want to see people lose money. Just again, when you compare it to owning not a few doors, you have to own a lot of doors. You have to have scale. And one thing this is really teaching, this whole what's going on now, and I think everybody can agree with this, whatever your net worth is, or whatever you think you should have, 10x it.
Yep.
If you think $1 million is a lot of money, your goal should be 10. If your goal is 10 million, make it 100. Because if nothing else is teaching what's going on in this world of volatility, whatever you think is your safe space to be in as far as net worth and cash, it probably is not enough. Unless you have a net worth of a minimum. Now, I'm going to get a lot of heat for this. Minimum $50 million. Why would I say such an outrageous thing? Because then you at least have a shot of having enough money, enough assets. And I don't mean cash in the bank. I mean assets paying you cash flow. Maybe you keep 5 or 10 million in the bank. The rest are all cash flow assets, because no matter what happens in the world politically, COVID, economically, you will weather that storm. If you have 2,000, 3,000, 5,000, 10,000 units of cash flow investment property, and it's constantly coming in, maybe sometimes it's a little bit over leveraged, maybe it's not cash flowing as much. We have people saying, oh, I thought the first year we'd have more cash flow. Hey, guess what? Sometimes the first year and a half cash flow is not where you want it to be. Welcome to multifamily real estate. But guess what? It's still cash flowing. You're still getting depreciation. You still have control. You still have scale. You still have leverage. Those things were not taken away. And we still have the property. So this is called reality.
How
That's
much
it.
cash flow do you think, if someone asked, hey, instead of a net worth, Michael, let's say I've got some money in the bank, how much cash flow should I have to feel good about being
Great question.
conservative and safe in this type of environment?
And we ask our client, we ask not clients, we ask our friends and investors that all the time. Hey, Bob or Mary, what feels good to you? Well, gosh, if I could have 5 or 10,000, cash flow every month, I'd feel great. To which I always say, why don't we make it 30? Because if you think 5 or 10 will get you through, which would be wonderful if it did, what if, God forbid, a calamity happened? Or you couldn't work for 6 months or a year? One of the things in our mastermind group we're doing is our good friend Brienne, who's also our partner on one deal, she's going to give birth to a beautiful baby in January. Well, guess what? She's not going to work for 3 months. Now, she has an incredible brokerage business, great earned income. But guess what? She also owns investment property at the ripe old age of 34 years old. So not only does she have earned income, but she has passive income. But what if you were to sit down with me or Sam or anybody, and you said, here's my passive income now. God forbid I couldn't work or something happened, or economically something happens, or COVID. What would my cash flow need to be that I could sleep at night, not just to get by, not just to pay my bills, but I could basically say, wow, I wonder, maybe I shouldn't even go back to work. Maybe I should just enjoy my life and sail away on a boat, or fish like my good friend Sam, who does it at 25-degree weather in a rowboat while it's snowing, you crazy bastard.
Yep.
These are the things that dreams are made of, but they're not dreams. People do it every day. So I'm not sure if that answers your question, Sam, but whatever it is, I would at least 3x it. You really want to be safe, 10x it. What are your thoughts?
Yeah, we get asked the question all the time, like, how much money should I invest? And I don't know, everyone's got a different number, but why would you stop investing, or why wouldn't you invest enough to have at least 15, 20,000 a month coming in passive income? I mean, that ensures that you get sick, you've got bills to pay, you're covered, your mortgage is covered, your cars are covered, and you've got some extra cash laying around. And so, people will gamble with their money in crypto, and Hal, I think you just jumped on, and a couple others just jumped on there in the background. We started this call talking about this crypto billionaire went from, was it 16 billion to less than $1 billion, and now going bankrupt. And that just does not happen in multifamily. It just doesn't, unless you over leveraged yourself in ways that are almost impossible with the lending regulations that we have now. Back before 2008, yeah, that happened because there is no regulations. It was the wild, wild west. Anybody could get a mortgage for anything they wanted on stated income.
Yes.
And the only really big red flag I see now in the real estate multifamily market is bridge loans.
Yes.
People could really get into trouble. And this is why we turned down so many deals that required a bridge loan. We took Fairmount 4 on with a bridge loan on a variable rate because of the massive amount of wiggle room and upside. There was a deal in Atlanta that I wanted so bad. There's a deal in Albuquerque. There was a deal in San Antonio, another deal in Cleveland. I wanted, and they just didn't have enough upside and wiggle room to get us through any type of recession. And guess what? If we had purchased those properties, guarantee you we would not be getting a good night's sleep right now. We'd be sweating. I'd probably be at the properties figuring out how to cut costs and get through the next year and try to refi these things. But I'm guessing we'd be in big trouble because those deals did not have the wiggle room, and whoever bought those on the variable rate bridge loans are probably in trouble right now. And those are the type of deals that we're going to be looking for in the next year to 2 years, deals that people probably shouldn't have purchased, or shouldn't have purchased at that price or with that loan, or should have just put more money down. That's what we're looking for, is those operators that shouldn't have done that. But the vast majority of multifamily investors right now are great. They have 3 to 10 year loans that are at low rates, and they're doing great. You just don't hear of real estate billionaires going from 15, 16 billion to bankrupt overnight. I've personally have never heard of it. Have you?
Sam, you hit it right on the head. In the 80s, there were guys and gals, mostly guys, that had some serious challenges. They all came back, but they almost, a few of them almost went under. That's almost impossible today, if not impossible, for the reason that you brought up, which is the key. When Sam and I look at a 20, 50, 100 unit property, $100 million property, the bank's not going to say, oh, sure, we believe in the number so much, we'll let you put down 5% or no percent or 10%. We have to put down minimum 25 to 40%. If not, sometimes they want even more.
Yep.
Our Dallas Meadow Creek deal, we were all set 30% down, really excited. What, a month before we're going to close or a couple weeks before we close? Oh, sorry, because of COVID, we want 40% down. Well,
2.5 weeks before closing and a week before Christmas, they said, hey, Sam, go ask Michael, Hal, and everyone else for an extra $1 million.
Yeah, so I'm a 64% owner in that property. Yeah. I had to cough up, along with Hal and some other people, we had to cough up an extra, what, $1 million? But guess what? We did it. The property is, our equity's doubled in value, most likely. Rents are skyrocketing. Will be at $160,000 a month, $115,000 a month a year and a half ago or a year ago, within the next 2 months. So look, you can't do it. You can't get over your skis now unless you have massive amounts of bridge loans or mezzanine financing or something on all of your properties. We have one that we control, fair amount.
You know what the other way is? I've found people get over their skis, Michael.
Yeah.
They mismanage the rehab.
You're absolutely right. Yes.
Banks right. Do regulate what's being done.
Yes.
But they can't force you to do it on time. They can't force you to do it quickly. They can't force you to do it well. They can hold money back if you don't. But, I'm thinking really hard, how would I go from 16 billion to bankrupt in real estate? And
well, I'll tell you how
the deals we buy, I can't think how it's possible.
Well, in the 80s, you did it by, or not going bankrupt, almost. Oh, watch. You had your good friend Donald Trump in what, 1990, whatever it was. He was a billionaire, and then he became less than a billionaire. But he was too big to fail. He went to the banks and said, "Hey, you can either put me out of business, or we can redo the debt." They said, "Fine, we'll redo the debt." Well, guess what? He came back roaring. But the reason why he and other guys and gals got into problems is because back then you could do stuff little or no money down, and they'd let you do whatever. It was a wild, wild west.
But again, they had tangible assets that the bank didn't want to take back.
That's right.
Crypto has nothing tangible,
right?
And that's why it can go to zero.
Yeah, there's nothing behind it. There's no real in the asset, guys and gals. Do you understand? We say this every week. I know it drives you crazy. There's either real in the asset or there's a paper asset or gold. Fine. Gold, at least you can sit and stare at, but it doesn't pay you anything. It's not even a good hedge against inflation, for God's sakes. If we're really, going to be bold about it, the best hedge for inflation. What's that?
I was trying. Go ahead. Sorry, something started auto playing on my computer.
The best. Well, you got me right in the middle of my rant. I was starting to scream and yell. I got so passionate about this. The best hedge for inflation, my friends, is a great piece of multifamily real estate. I don't mean 2 or 3 or 5, 10 units. I mean no less than 100 units, 200 units, 300 units. That mother thing is the best hedge against inflation or anything else, COVID, you name it. And we've been through it, Sam. You and I have been through it, along with our partners and friends on this call. We've been through COVID. We've been through Joe Biden. We've been through, all these different things.
Yeah, and we've had some challenges, and that kind of brings us to the next point that we wanted to talk about today. Trying to pull up that video that you and I did on it on crypto. I'm almost there. But we've had some unhappy investors, to be honest, that say, hey, why the heck am I not getting my distribution that I was promised or guaranteed? And I said, hold on.
Yeah.
No one promised or guaranteed anything. This is an investment. We gave you projections based on a conservative underwriting platform, and our conservative just our how we do deals. And those are best estimates. What we did not plan on is rates going up by more than double. And if you look at our underwriting, we did plan on rates going up substantially, just not more than double where they were. And so it has created some challenges specifically for Fairmount 4. We distributed a 3% distribution instead of a 6% because our variable rate loan has brought down cash flow. And we also want to leave some in the bank to, see where things go and have some rainy day money, have some peace of mind money in the bank in case we do have unexpected expenses, in case rates continue to go up, or in case the refi, poses some challenges and takes longer than we think. So while we aren't doing as well on the cash flow on that property now, we're being smart about it. We're not in trouble. We're not worried about it. We're actually finishing the rehab 18 months ahead of time in order to refi 18 months ahead of time in order to lock in lower interest rates as soon as we possibly can on a long-term loan. So we're doing fantastic there. We're way ahead of schedule amid the supply chain issues, amid the challenges of the contractors in Cleveland. So we're doing great, but cash flow, it's the whole economy's down. And I think that's one thing our investors need to remember is it was never guaranteed, but your preferred return, if there's a preferred return on a deal that you're in, it's still accruing. You'll still get paid. And by the way, we don't get paid a dime until you get your preferred return caught up completely. So I'm operating this deal for free right now, and our investors are always first. And that's and that's why Grant Cardone's being investigated right now. Someone texted me yesterday, our good friend Danny. He's like, "What's up with Grant? Like, why is he being investigated?" Well, he got paid first. He made sure he got over $110 million in profit before his investors ever made any profit. And that's what they're unhappy about. Michael, you and I are the opposite. We actually postponed getting paid most of our income on this deal, the management side of the income, managing the rehab until the rehab's done and we've executed the refi. So we actually have postponed getting paid to make sure we're putting our investors first.
First of all, those are all great points. I'd like to point out something and have people consider something. I personally have $1 million in F4. And when we talked about high level, what we were going to do to play it safe until we do refi or sell the property, but hopefully we'll just refi it.
Michael, someone just
Go ahead. I found the TikTok.
Good. So when we were talking high level, what we should do in the next few months, we went over the numbers and we said, okay, we're going to cut the distribution in half, which means that I, along with everybody else, am not getting 6%. I got a 3% distribution. Was I happy about it? No, but quite frankly, I was happy just to get a distribution, because if you saw the numbers that I see and that Sam sees and what we're trying to do to make this be the winner that it is, no question about it, then we would say, yeah, this is what we have to temporarily do until we finish the product, which we're going to have done the next 2 or 3 months, which actually I'm very happy about. I'm very actually happy with the asset itself. But here's something you have to consider. While we're taking 3% from F4, which is not the norm for my investment or MFI's investment, let me tell you who that is the norm for, a 3% return. Blackstone and Grant Cardone.
They love that shit.
And guess what? Their clients are ecstatic when they give them 3%. That is not good enough for me and Sam or anybody else. But when people say, well, who are you guys? Well, that's fine. That's legitimate. But Blackstone, Grant Cardone, many other high-end companies like that, their clients are used to making 2 to 4% on their money because they're looking for preservation of the asset, preservation of wealth. We, of course, want to preserve our wealth, but we also want to expand it by the types of deals we buy, great locations, but add value properties. And guess what? Sometimes in the first year, or maybe even a little longer, you're not going to get a 5 to 7% return. We believe we will, but when you have the debt market double in 8 months, guess what?
Yep.
There are consequences for that. And you have to have, I've said this many times, the temperament to understand that. We don't deal in fantasy land. This is reality. So I'm not quite sure if everybody makes sense what I just said, but that's the way it is.
Yeah,
So,
you know, we're playing the cards that have been dealt, and we knew going into this deal that we'd have to execute the remodel as fast as possible and increase the NOI and refi as fast as possible. We knew rates would go up. So this has been part of the plan. The part that wasn't part of the plan was how high they went up. But you know, I think our investors need to understand that the value of the property has gone way up. And if you look at your return on investment between
Sam,
tax,
excuse me for interrupting you.
go ahead.
Why has the value, because you're saying, well, how do you know that? Rents aren't going up as fast as we want, cash flows. What is the formula we use specifically on something like F4 to determine that we know that our equity has most likely doubled in the last 12 months?
Yeah,
So
we've taken
explain
the net income, the net rents after expenses from just over 100,000 to $190,000 in 1 year.
Say that again.
In 1 year, we've taken the net income from just over $100,000 a month to $190,000 a
So
month.
almost doubled in 1 year.
So that's why the value's gone up so much. So while you're not seeing cash in the bank through cash flow, this is all part of the plan. We said we would average 15%, hopefully annual average return. Well, we're way ahead of that right now, not via cash flow, but via appreciation and via tax write-offs. So you guys all got some really great tax write-offs, as did I. I'm invested in this deal as well. So, you know, you have to understand the investment. And I think that's one thing that some of our investors, maybe they trust us too much and they don't dig in enough on these deals. You're not getting 50%, 15% cash flow. You're getting appreciation, cash flow, tax write-offs, and it's a long-term play. We knew a recession might come. My podcast is called Recession Proof Real Estate Investing for a reason, because I've been waiting for the next recession to come, and I wanted to educate people on what type of deals to buy and what type of assets to be in. And you know, while crypto is bankrupting people, multifamily is preserving our capital, and we're still increasing in value. So really quick, I'm going to share my screen, Michael. And I want to play this video we did on crypto. Can you see that TikTok video okay? And look at some of the comments, because I'm assuming none of them are going to even talk to us right now, but they were calling us boomers. We didn't know what we were talking about. Crypto's the next best thing. Real estate's obsolete. So hold on, guys. Listen to this. You just got to love this.
Told me they didn't want to invest with us because they wanted to invest in crypto. I guess they're gamblers though, because that's not really investing, right?
I'd rather be in Vegas than I'll eat well, shop well, see naked women running around. I mean, that's much better deal than crypto,
Better way to gamble
but a much better way to get.
by far. So Michael, someone just told me.
So we call investing in crypto gambling. Again, there's no real asset. And, you know, people were telling us, hey, you're a boomer. Tell me you don't understand crypto without telling me you don't understand crypto. Well, Rich, Matthew, all you guys that commented on this video, tell me about your crypto portfolios now. You know, tell me about the tax write-offs you're getting from these crypto portfolios, and that you're not getting. While our F4 and other properties are going way up in value still, they're cash flowing, and NOI is increasing every month in Dallas and El Paso and Cleveland. People who invested in Bitcoin are struggling, and in some cases going bankrupt. And that's an asset that can just disappear. Meadow Creek is not disappearing out of Dallas anytime soon. The Cleveland Clinic and all our apartments next to the Cleveland Clinic cannot disappear. So that's what I'm loving about that video we did, Michael. We are not gamblers. We are very scared and conservative and careful with our money.
And you know, the interesting thing is, I think that was over a year ago. Sam.
That was June 1st, 2021.
Wow.
So anyways, we've got some fun property updates. We're going to be sending you guys pictures and videos, painting and rehab and remodels and lots of different things going on. The name of the game right now for us is making sure properties cash flow, and the economy is slowing down a tiny bit. We are having a little bit slower months as far as getting units rented out. We're increasing advertising. We're increasing some of the incentives we do for renters to get them moved in, and our property managers are doing fantastic. We're working on a lot of our internal systems at MFI Club to manage and really push hard on these property managers. Michael, you've been hitting the business plan, year end of business plan really hard every week, which is great. And Calvin and I and the team have been working really hard on our execution of the business plan and tracking the numbers and really understanding every single vacancy. And I don't know if our investors understand this, but we track every unit that's vacant. We have over 1,700 doors. Any unit that's vacant more than a couple weeks, we're talking about with that property manager to say, why is it vacant? What is the issue? And what can we do to rent it out?
Right.
Also, delinquency, Michael, we've been hitting on that. Why are they delinquent? Have you banged on their door every day for the last week and told them they need to pay rent, made a deal with them, told them we don't want to evict them, we want them to stay, we're willing to work with them? And so we've been pushing hard on every single door that we own to make sure that we do what's best for the tenants, keep them in the units, don't evict them, keep our cash flow high, and manage these properties well. And it's a lot of work, but that's what you have to do if you want to cash flow through an economy that's slowing down.
Guys and gals, the key word is fanatical. We are fanatics about cash flow, about occupancy, vacancy, following the business plan. Fanatical. We drive our managers sometimes crazy. God knows I drive MFI sometimes crazy. But all we care about are the results. It's our money at stake, your money at stake, all of our money together. And so you have to be fanatical if you want to have a nice Christmas, a nice New Year, sleep at night. That's the price you have to pay. You don't, but I do, and Sam does.
Yep. And we're improving every month and working on better operations, better advertising, better tracking. And we're really in a holding pattern. Lyndon asked me right this morning what we're looking for at the moment. I'm looking for a killer deal. If we're going to buy a deal right now with these rates and this volatility, I want to find something where someone's in trouble, someone really needs to sell, and those are the deals we're looking for right now. So blood's in the water, we're sharks just swimming around looking for the next meal, and I can't wait to find it.
I can taste it.
Yes, sir. Yes, sir. Well, with that, guys, please reach out to us if you have questions. A number of you have changed emails and not let us know, and then you're mad at us because we're not communicating with you. So I'm just going to make the comment right now. If you change your email and don't tell us, that's why you're not getting emails. Happened yesterday. The gentleman was pretty upset with us and said we haven't emailed him in months. We checked our records and he had changed his email and not reached out to us and let us know. So please update your info, log into your portal, make sure it's updated, make sure you're getting distributions. All of them went out on time this month. And we're also sending out emails and explaining the distributions. We're sending out a recap to this call. So if you're not getting lots of communication from us, please text me, call me, let me know, and we'll fix the problem, because we want you guys to stay informed, because educated friends, investors, and clients are happier, and we just want to keep pushing towards more deals and better cash flow. That's it. That's all I got.
Thanks, everybody.
Okay. Have a good weekend and take it easy.